everybody, welcome back to my channel. Previously I had made a video in which we discussed about taxation of dividends received from Indian companies and mutual funds. The link to that video has been provided in the description below. In today's video we will discuss about the taxation of dividend income received from foreign company. If you are new to my channel, I request you to subscribe and hit the bell icon below so that you can get notified when I post new videos. So let's start the video. Dividend received from a foreign company is taxable. It will be charged to tax under the head income from other sources. Dividends received from a foreign company will be included in the total income of the taxpayer and will be charged to tax at the rates applicable to the taxpayer. For instance, if the taxpayer comes in at the 30% tax slab rate, then such dividend will also be taxable at 30% along with cess. The Finance Act 2020 also provides for deduction of interest expense incurred against the dividend. Even in case of foreign dividend, the investor can claim deduction only for the interest expense restricted to 20% of the gross dividend income. However, you are not entitled to claim a deduction for any other expenditure, like commission or salary expense incurred for earning the dividend income. TDS on dividend income. However, the company declaring the dividend will have to deduct TDS under Section 194 of the Income Tax Act 1961. As per this section, 10% TDS is applicable for dividend income above Rs 5,000 for an individual. This rate will be increased to 20% in the absence of PAN submission by the recipient of the dividend income. If foreign tax has been deducted at source on dividend received, you need to gross up the income. This means you report the total dividend income before the deduction of foreign taxes. For example, you received a dividend of $1,000 from a US company and $150 was deducted as tax in the US. You would report the full value, that is $1,000 as income in India, not just $850 you received. Foreign tax credit. To avoid double taxation, India offers a foreign tax credit for taxes paid abroad. This means you can claim a credit for the tax already paid in the foreign country against your Indian tax liability. Now we will see what are the conditions and documentation required to claim the foreign tax credit. To claim this foreign tax credit, you must provide proof of foreign tax paid, such as withholding tax certificate from the foreign company or tax authority. Additionally, you will need to file Form 67 before the due date of filing your return in India. For example, if your Indian tax on the $1,000 dividend is rupees 15,000 and you have already paid rupees 10,000 as tax in the US, you can claim a foreign tax credit of rupees 10,000, reducing your Indian tax liability to rupees 5,000. Relief from double taxation. Dividend received from a foreign company gets taxed both in India and in the home country of the foreign company. However, if the tax on an international company's dividend has been paid twice, that is paid in both the nations, then the taxpayer can claim double taxation relief. The relief claimed can be either as per the provisions of the double taxation avoidance agreement entered into by the government of India with the country to which the foreign company belongs, or he can claim as relief under section 91 in case no such agreement exists. This means that the taxpayer doesn't have to pay tax on the same income twice. In summary, while the dividend income from foreign companies is fully taxable in India at your applicable slab rate, you can claim a foreign tax credit for taxes paid abroad to avoid double taxation. Always ensure you have the necessary documentation and file the required forms on time. The best option is to consult a tax expert and seek their guidance on this matter. Thanks for watching the video. Don't forget to like, share the video and do subscribe to my channel for more insightful videos on taxation and finance. I will see you all in the next video.